So before starting this topic called money and banking, have an idea about the trend of money and banking question being asked in the last 6 years, that is in relation to 2011 to 16. If you see that every year minimum 3 questions have been asked consistently. 3 questions minimum they are asked in all the 6 years. And in 1 year they are asked 7 questions also. In 1 year they are asked 7 questions. Just see that which year they are asked 7 questions. But one thing I can guarantee, UPSC have given lot of importance to this topic, money and banking. Okay, and if you see the money and banking question, as already mentioned, there are 2 categories of question. One is concept related question, and second is current affair related question. Now in 2016, all the 3 questions were current affair. They asked question from MCLR, which I will be discussing today, then payment bank and core banking solution. See, after today's session, at least we have an idea about the question. See, I already given you that file. I posted you that file in the economic group. Just see the questions from money and banking to have an idea what way UPSC asks question, what are the significant area for your coming prelims also. Okay, so this you need to be very clear. Whenever you study a subject, you need to understand its importance. Then only, see, if you now, some people will be asking, sir, why sir is posting so many money and banking related article? Reason is simple, that at least 3 questions out of 100 questions, if you are sure that 3 questions is going to come from this area, that too mainly from current affair, there is nothing wrong in it. If you read article and be thorough with it, you can answer. And I am expecting this year to get more questions because of demonetization. Okay, so just have an idea. Now I'll tell you, after demonetization, now itself I'm telling you, after demonetization, 2 very important concepts. There is high possibility from these 2 questions will come, which I'll be discussing today. One is in relation to incremental CRR. See, don't worry, we'll discuss. Have you seen this term incremental CRR? It's coming in the newspaper regularly, it's repeatedly. Second is MSS bonds. See, these 2 topics were not at all important before November 8. Because it was not at all there. This concept just came because of demonetization. Incremental CRR concept came because of demonetization. MSS bond, which were used very rarely and for a different purpose, have been used for after demonetization for a particular purpose. Now these 2 current affair topic have arisen because of demonetization. So if you want to understand these 2 concepts, see, even though it is a current affair, you need to be very clear with the concepts. They will ask questions related with the concept of these topics. So be very clear, and again I'm telling you, this, if you see the time period, that is from November a particular time to December 10th. Now, after today's December 11, right? So incremental CRR is over. It was there till yesterday. The validity of incremental CRR was there till December 10th. It's over. Now why it is over, we'll come to it. Now MSS bond. What is that and why the government have done, and you will see again news related with MSS bonds in the coming days ahead. And I'll tell you, after today's session, go and read all those articles related with incremental CRR and MSS bond, you will be very clear with that. You will easily understand the concept. Okay. Now keep this in mind. Why I am giving so much of trust to these two topics is when you revise money and banking topic, give importance to these two. Give importance to these two. Okay. In money and banking, the most important topic is in relation to the monetary policy. In relation to monetary policy. Have a idea in relation to who performed this policy and what is the purpose of this policy is all about. In India, normally, all over the world, the monetary policy is performed by the central bank of that country. Monetary policy is performed by the central bank of that country. So in India, who will be performing that function or that policy? It will be RBI. So monetary policy is performed by the Reserve Bank of India. RBI, Reserve Bank of India. Now, what is the purpose of performing this policy? Now try to understand that RBI in every 2 months will review its monetary policy. Every 2 months. So whenever RBI review its monetary policy, something will happen. Okay, recently also RBI reviewed its monetary policy. So have an idea. There is a bi-monthly review in relation to monetary policy. And the basic aim of this monetary policy is in relation to controlling the money supply in the economy. In the sense that RBI want, or instead of money supply, you will come across another term, what is called as liquidity. Both are same. Liquidity or money supply. So RBI want ample liquidity in the system. When we talk about the system, we'll see that actually where it is lying, this money. Okay, so by having a sufficient liquidity or sufficient money supply, RBI ensures that by controlling the monetary policy or through monetary policy, RBI ensures that the inflation is in control. It's a very important point. That's I told you, na? The topic is interrelated. When you discuss money and banking, you need to be very thorough with inflation also. But I'm not going in detail to inflation, but just have an idea that this is one of the prior area, or prior means the RBI in its monetary policy give most importance to controlling inflation. Now, what is this inflation? In simple term, inflation is nothing but there is a general increase in the price level or persistent increase in the price level, not general, persistent, continuous increase in the price level of the commodity or services which you use. Okay, now what's the problem when there is a persistent increase in the price level? Do you like the commodity which you consume or the services which you use continuously? Today price was this much, tomorrow it is, or after a week it is increasing. Will it affect you? Will it affect your lifestyle? Yes. Now who will get affected the most? The poor. The poor people will get, they are the people who get most or worst affected with inflation. Okay, rich people will they get affected? Not that much. Imagine a family who are having a salary of 8,000 or 10,000 monthly salary. They have to live with that salary. Now for them, increase in their food items or in the basic services will result in lot of trouble. Yes or no? So controlling inflation have been given utmost priority by the Reserve Bank. So while controlling inflation, it has given importance to this thing also, what is called as economic growth. Second, or it need to do a balance with this. What is called as the economy also have to grow. Keep this. This is a very interesting point. Economy. See, RBI have to control. RBI have to control inflation. RBI have to ensure that the economy grows. But both are the actions have to be different. Now try to understand. Now for the economy to grow, what are the basic requirements? For the economy to grow, the business have to grow, or all the industry, everything, services have to grow. When I say business, it includes agriculture, industry and services. Yes or no? Now, for the business to grow, what is the basic requirement? The borrowing. See, do you think that all the business people do business from their own money? No, they borrow. They borrow from the bank. So they require. So when they borrow from the bank, they have to pay interest rate. Okay. Now suppose the borrowing cost or the interest rate is high in the economy. When the interest rate is high in the economy, will it affect the business people? It affects the business more. They will spend less. So once they spend less, the output, the economic growth will get affected. Now try to say this is a balance where RBI have to keep both, that is controlling inflation and ensuring economic growth is through sufficient money supply. You getting the point? Money supply determines both. Now you think how money supply. Now imagine a situation. There are a lot of money in the system, ample liquidity in the system. Everyone, now you just see your behavior, how your behavior changes. Now, how much there is there in your pocket? Now I am giving you 10,000. After leaving from today's class, I am giving you 10,000 each from every one of you. Just imagine. What will you do after leaving from this class? You'll directly go to Central Mall and finish it off. And if you don't have a smartphone, at least buy a smartphone. Have a good food over there and watch a movie. If possible, watch 2 movies and come back and finish it off. And yes or no? Because you got whether or something like that. Or some people will go and buy something else. But what I'm trying to say is, when you have money, extra money in your hand, your behavior also changes. So what has resulted in this? This has resulted in, so when you have more money in the system, it results in more demand. Now when there is more demand, what will happen to the price? The price will increase. Yes or no? When there is more demand, it's natural. If you see the demand supply mechanism, when there is more demand for anything, when there is more demand, the price of that demanded item will increase. That's quite natural. Similarly, so what the RBI do? RBI knows that. So RBI will not inject, this term is very important. RBI will not inject so much of liquidity. RBI only inject that liquidity, that much liquidity or that much money to ensure that it can control inflation. So this concept I will discuss in detail when I will discuss the topic inflation. But just have an idea because it's related. Now similarly, so when the RBI try to control the money supply, now think from the banking system point of view. When every banks have, now see the present situation. Now every bank is having sufficient, more liquidity, yes or no? Every bank is having lot of deposits in there. So much of deposits is there with the bank. Now bank have so much of deposit, bank is ready to lend. Bank is ready to lend at a lesser interest rate with lesser conditions. Because our bank is having sufficient liquidity. Now once the bank is having sufficient liquidity, the bank may reduce the interest rate, and that is good sign for the business people. But the present trend is different. So don't compare the present trend with because the present trend, the businesses get affected even though bank is having sufficient liquidity. Reason is nobody is having cash. See, India is a cash economy. Now the government want to make it a cashless overnight, and that has affected the entire business. So I'm not going to that in detail. That we'll discuss under demonetization. But what I want from you is try to understand the relation between inflation and economic growth. How money supply can affect inflation. Just have an idea. Don't go in depth. Just how money supply can affect or boost economic growth. So money supply is not, see, don't think that only money supply is sufficient. There are other things required. But I am saying that the relation between, so the relation is in relation to economic growth, the relation is simple. Relation is in relation to interest rate. So economic growth have a relation in relation to the interest rate regime. What is the present interest rate regime? Whenever there is a low interest rate regime, when the interest rate is low, it will result in more business activity, and that will result in more economic growth. When the interest rate is high, opposite. So RBI by controlling the interest rate through its monetary policy, that is by controlling the money supply, RBI can have a control over, or it can either support, or it can based on the inflationary situation. So if the inflationary situation is easing, then the RBI will give a easy money policy in the sense that there will be ample liquidity in the system. That will result in lesser interest rate regime, and that will boost the economic growth. Just have an idea. We will discuss in detail about this again and again and again. But try to have this relation regarding inflation and economic growth. Now we'll see it. So we are going to discuss in detail regarding so try to understand RBI through its monetary policy, have two core objectives, that is inflation, controlling the inflation, and to promote economic growth. By doing so, it uses certain instruments. So how RBI control monetary means how RBI performs monetary policy? By controlling credit, or by controlling money supply. So RBI uses certain instrument to control money supply in the system. You need to be very clear what are those instruments, and it's very, very, very important for you. Okay. Now, so we'll start with one by one. So we are giving importance to its most important monetary policy function, that is what is called as RBI as controller of credit. This is the most important topic in relation to monetary policy. RBI as controller of credit. So RBI as controller of credit. So how RBI control credit? It uses several instruments. The most common instrument, that is conventional instrument, which was used by RBI from its initial period. One is bank rate. Try to understand what all things I am going to discuss now is in relation to these are all instruments used by RBI to control money supply. Okay. Now what is this bank rate? Rate is something, it is an interest rate. Now in relation to, before discussing this bank rate, I need to discuss a concept what is called as discount and rediscount. Two different concepts, discount and rediscount. Okay. Before going to, so this is related with the bank rate, discount and rediscount. Before going to that, to explain discount and rediscount, you need to have an idea what is called as bills of exchange. bill of exchange or bills of exchange. Have you seen check? You all have a check. Now, what is the specialty of a check? You write, means it's a financial instrument. Yes. Once you write it and give a date, you write date in that check. If you write the date in that check after 3 months, when it is having that validity, you have a check which is dated, post-dated, mentioning the date as 31st March 2017, and the amount returned is 1 lakh. Now, when you can get that money? If you go to that check and go to bank tomorrow and ask the bank, I want 1 lakh rupee, will the bank will give you? No. The bank will say that it's not valid now. You come on. It's valid only on 31st March 2000 or after. So similarly, there are certain instruments like letter of credit for exporters. In the sense that when an exporter export a particular commodity to its destination, the payment they receive, it will be mainly in a bill of exchange or what is called as letter of credit. Now the specialty of this bills of exchange is that it will be having a financial value, it will be having a monetary value, but it will get matured only at a future date. What is common? It will get mature only at a future date. A particular date will be given. Now if you want before that future date, if you want an amount before that, what you can do is you can go to a bank. You can go to a bank and discount that bill of exchange. Word is very important. Okay, now if you go to a bank with the check, the bank will tell you get lost. But there are certain banks, especially State Bank of India. If you go to HDFC and ICICI Bank, they'll say that no, you come on 31st only. How can I guarantee that this amount I will be getting it? Because in that account there will be no money on 31st March 2007. This can also happen. So the credibility of the customer and the date check issuing fellow is very important. If that check is issued by Ambani, then the bank will accept it. Bank will for 1 lakh bank. But if some unknown person is issued, we can't guarantee it. So similarly, but in the case of letter of credit, that is in relation to exporter case, that is a different thing. There is a proper mechanism is there. But I just want to tell you the concept, what is called as discount and bill of exchange. So bill of exchange will be having a value, financial value will be there, and it will get matured only at a future date. Now if you want that to get matured, if you don't have time or if you want money urgently, what you can do with that bill of exchange? Go to a bank and get it discounted. Discounted in the sense that the bank will take a commission for it. And that discount rate, so suppose if the amount is 1 lakh, the bank may take discount that bill for 7%. In the sense that if you go with the bill of exchange of 1 lakh, the bank will give you only 93,000. 7,000 the bank will take. And how the bank will benefit? The bank will wait for that maturity date, and once the date gets matured, the bank will get the full money, 1 lakh. You're getting the point? So you have an idea what is bill of exchange and what is discount. What is discount? So discounting happens for a bill of exchange. And the person who get discounted will get, the discounted rate will be actually it's like an interest rate. Discounted rate is nothing but it's like a interest rate. Similarly, now as a customer you have discounted your bill of exchange, but the bank now need money. Bank now need money urgently. Now for bank there is an option. It can go its own bank. Bank's bank. Bank's bank is the central bank or RBI. Now when the bank go with this discounted bill of exchange and again they convert that bill of exchange to money at a lesser rate, we call it as rediscounting. This term is very important, discounting, and you can draw a figure, then your concept will be very clear. Draw this figure so that discounting and rediscounting will be very clear. And this term is very, very important also. Reserve Bank of India, bank, and a customer. If the bank, if the customer is approaching the bank to discount the bill of exchange, it is called discount. If the same item, if the bank want to discount it, we call it as rediscount. So when you see the term rediscount, there will be no customer. It will be between bank and the central bank. Now try to understand that the discounted bill, if it is again discounted, it is called as rediscount. So that happens between bank and the central bank. Similarly, there is another concept, what is called as financing and refinancing. Again, this term is very important. Financing and same concept. Financing means what? Giving loan. Financing is what? Giving loan. Refinancing is who is giving loan, if that is financed by some other else, it is called as refinancing. It is called as refinancing. If you see the 2016 prelims question, there is a question what is called as Stand Up India. In Stand Up India, there is a statement, you will come across a term what is called as refinancing. Just go and check it. We'll discuss when discuss it or state government scheme. So why I am telling is that term is very important. Term is very important. You need to know the meaning of it. Okay, now normally bank finance, not only bank, other financial institutions like microfinancial institutions or even NBFC like Muthoot Finance, Manappuram also finance you. So they all finance you. But if they if it is that the amount they finance is being borrowed by someone else, from someone else, that is what is called as refinancing. So we generally take, in money and banking, we take mainly bank and RBI. So here, if the bank which it is using for financing is taken from RBI, it is what is called as refinancing. So don't think that it's always RBI performs refinancing. There are other bodies like, if you see National Housing Bank. National Housing Bank is a subsidiary of Reserve Bank of India. And as the term suggests, it has a core area to whom it will lend. It will lend only to housing financial companies. So National Housing Bank, if it lend to HDFC and HDFC is lending to you, so National Housing Bank is providing refinancing to HDFC. Don't consider HDFC is different, HDFC Bank is different. HDFC Bank is a commercial bank, HDFC is a housing financial. Similarly, SIDB provide refinancing options to some other bank or some microfinancial institution, and they lend to customer. That is also refinancing. So the refinancing or rediscounting is in relation to customer. If some intermediary, say here bank is an intermediary, taking money from RBI and giving it to the customer, that is what is called as, if that is happening, we call it refinancing in relation to lending, rediscounting in relation to discount. This term has to be very, very, very clear. It's a simple concept. Okay. Now we discuss bank rate. Bank rate, now it's not that important in the sense that whenever RBI don't use this instrument as its major policy instrument, but it is from your examination point of view, you need to know it. Because UPSC asked several times, what is this bank rate? So it is nothing but it's a rate. It is the rate at which the central bank provides the rediscount to the bank. The rate at which the central bank provides rediscount to the bills of exchange of the bank, which the bank give it to. So it's nothing but bank rate is either a rediscounting rate if it is in relation to bills of exchange, or refinancing if it is providing any lending. I told you that is now it's not happening. Now generally this bill of exchange is in relation to the rediscounting rate. So bank rate is nothing but a rediscount rate. Now try to understand that when we talk about rediscount, whoever is there in the picture, it is between central bank and the bank. Now whether the bank rate can influence money supply. Now keep this in mind. We are talking about the topic called RBI controlling credit, and bank rate is one of the instruments used to control bank rate is one of the instruments to control credit or control money supply. So how RBI can control money supply through bank rate? By increasing and decreasing the bank rate. By increasing and decreasing the bank rate, RBI can control money supply. We just will explain in relation to an example. Now imagine the discount rate. If the discount rate is somewhere around 10%, just rediscount rate is 5%, now presently 5, and the discount rate may be at 7%. This is the present. So at this case, what the people will do, means the customer will do, they'll go to the bank for discounting their bill of exchange at 7%, and the bank, if they require money, they will rediscount it at 5%. This was happening. So there were ample liquidity. Now when RBI feels that there is more money in the system, RBI want to restrict this. Now when we talk in relation to money supply, try to understand that when we talk about money supply in the system, if the money is with RBI, there is no problem. It's not there in the system. If the money is with RBI, keep this very core point. If the cash or money is with RBI, it is not with the system. If the money is with the bank, with the people, or money is with other than RBI, then we call it the system. So be very clear. System includes mainly all the banks, financial institution, and with the people. Now here in this case, in relation to bill of exchange, if the bank, if the RBI increase this to 8%, if the rediscount rate have been increased from 5 to 8, what will happen? The bank also will increase the discount rate to 10%. Now the bill of exchange is, the money presently is not there. Imagine that the bill of exchange is 1 lakh. Earlier this fellow will get how much? 93,000. Yes or no? For 1 lakh he used to get 93,000. Now with this rate will get only 90,000. Then the customer will think, should I liquefy it or wait for the time till mature time? There is a possibility that this fellow will not liquefy the bill of exchange. He will wait because he feels that this is not profitable for him. So since he is not going to liquefy this bill of exchange, he will not go to the bank, and the bank will not go to the RBI, and RBI will need not to inject that liquidity. So by increasing, so what will happen? That money which might not have released to the system have been blocked by increasing the bank rate. Similarly, by decreasing the bank rate, imagine the case from a discount rate have been from 5% to 3%, rediscount rate. From 7 it will be 5, and then the people who are having bill of exchange, they will quickly liquefy it, and that much amount will be injected to the system, or that liquidity will be injected. So RBI, by increasing the bank rate or increasing or decreasing the bank rate, can control money supply. So this policy through bank rate, if it is tightening the money policy, or if the bank is increasing the RBI is following a policy of increasing bank rate, we call it as tight money policy. Tight money become tight. And if the bank rate, RBI is decreasing the bank rate, we call it as easy money policy. Money is easily available, easy and tight. It's there in the material. So are you clear with the concept bank rate? Now you are clear with the concept bank rate. What is the purpose of why RBI uses bank rate? That is very important, to control money supply. Now we will see. So this is concept. Now we will see the question asked from bank rate. Now that will give you much more clarity. What type of question have been asked by RBI in relation to bank rate? Take question number 5. It is question number 5. It is a 2013 question number 5. Those who have done question number 5, then do question number 10. What is the answer for question number 5? An increase in the bank rate generally indicates that the central bank is following a tight money policy. And question number 10, the lowering of bank rate by the Reserve Bank of India leads to more liquidity in the market. This is how UPSC asks question. Which year it has asked? 2011 and 2013. It's a simple question. When you know the concept. Said UPSC don't ask tough question. Only thing is that you need to be very clear with the concept. Conceptual clarity has to be there.